Hello, everyone, and welcome to today's session. Let's jump right in here and get started. Long-term market timing signals. This is typically where we start out every morning when you're analyzing current market conditions. This is a quick glance to say where are we at in the trend. Okay, so I like to start out these presentations and as far as the process to follow or the process that TradersPro utilizes in looking at this top-down approach. A top-down approach is what is the market conditions, what are the market conditions doing, what is the market doing currently, and what do we need to be able to set as a bias? Are we looking at the upside, the downside? Are we extended to the upside? Are we oversold to the downside, or are we somewhere right in the middle? So instead of trying to anticipate what the markets are doing, what we prefer to do is talk about what the market is doing currently and then making our strategy based on what the market is doing currently. Because typically trends, as they advance, as they stall, as they start, as they stop at a market level, it's typically a relatively slow process. It doesn't happen in minutes or even days. Even if you have a big sell-off, that can be the first sign that we need to make some kind of adjustments. We've got too much risk, or I don't have enough risk, or whatever the situation is. In the big picture, really what we want to focus on is slowing things down so that we're looking at a little bit bigger, slower picture. And I think a lot of traders and investors kind of get stuck in one side or the other. In that, on the one side, you have I'm going to buy some stocks and I'm going to forget about them. I'm never going to look at them. I'm going to open my brokerage account now and then, and I'm not really going to be paying super close attention to that. There's not necessarily a strategy involved. On the other side, it's buy and sell, buy and sell, buy and sell, overly aggressively trading, trying to make some money for that day instead of having an overall strategy and a portfolio goal. And that's really what Traders Pro is designed to do, is help in analyzing great companies. We're looking for great companies that are currently trending, that are moving higher in bull markets. We want to be able to take advantage of those great companies that are growing, that are moving to the upside, and participate in those companies. And we want to be able to do it at a portfolio level, meaning we want to own more than one stock at a time. We may want to own 20 or 30 stocks at a time. We may want to own 5 to 10 at a time. Typically, in terms of allocation, with our model, we usually don't get many more than 30 on the really on the upside, where we're pretty full with a portfolio. And part of that is just the rotational process, the wheel process of buying and selling doesn't allow for that many holdings at once unless we really have a good uptrend or a really strong market and we don't get stopped out of anything. We're typically still going to be selling into some of that strength. But in essence, that's really what we're focused on doing. So a lot of times when we're looking at that process, you just start from left to right. What is the market doing? So we start off with this. Some of these down here may not be quite as valuable. In the shorter term, they are, because that's what we're looking at. We're looking at what is happening in the shorter term. This long-term perspective is where are we at in this long-term trend? We know that we're to the upside. In the shorter term, we're getting these three indicators, which are, we want to look at sentiment, we want to look at breadth, we want to look at momentum. Momentum is essentially what is the price activity of the market? Okay, are we moving to the upside? Have we moved aggressively to the upside? Are we at the top end of the range? Are we at the bottom end of the range? And the bottom end of these ranges are going to have some corresponding momentum retracement. Same with the upside. You're going to get, this is not lining exactly, but this is the top here, and then here. So when we're in certain ranges, we know that those areas, even though they may continue to trend for a little bit of time, we're due for some kind of a pause. Markets just don't last. They don't go up forever. They don't go down forever. But they also we don't have bull markets and bear markets that are transitioning, monthly or weekly. Those take years to develop. And so we don't necessarily want to be in and out of a lot of different things in a real short amount of time. Again, it's about building portfolios of quality stocks that we anticipate to go higher And then obviously we want to be in bull markets. Anytime as we have a bear market and we're moving to the downside, something like this, any stock that we buy, it's going to be a lot tougher for those stocks to go higher because markets are just linked. Everything is linked. And when you get, markets in a downtrend and everything is selling off, then you're going, especially with the way that we have everything linked to indexes now, and index investing is really, really huge and moves the entire market. And so it'll move stocks. So index investing, meaning you're buying the S&P 500 or you're buying the Russell 2000 or you're owning the index. And because when those indexes move up and down, the individual stocks also have to be moved up and down. And so there may be good stocks inside of those indexes that are getting, the baby in the bathwater idea. Everything just gets tossed out when we're in bear markets. And so it's a little bit tougher to trade on the long side, looking for bullish scenarios. But in this case, certainly we're right at that the upside of that market condition to the bullish scenario right here. From here, we go over to the buy-sell ratio. This is a little bit shorter term, so day by day, we can watch that and see where we're at. We're currently at 0.76, so a healthy bullish trend is going to be above 1. So you can see we've kind of notched back down to the downside here a little bit. Red is moving above green. When we've had this most recent counter trend or retracement as of yesterday and the last couple of days really on S&P 500. But really that's that mildly bearish scenario has started to happen because we're starting to see some shifts. Short-term down, long-term trend is still up, but we're starting to get that shift out of momentum back into kind of this counter trending or pausing, this yellow non-trending scenario where it's range bound and just gives us a little bit of a pause, gives us a correction. Doesn't necessarily mean it's going to be a new aggressive downturn, but that's how they start. They all start like this. Okay, they all start like this, and they can turn into this. They start like this, they retrace, they could move higher. So we just don't know exactly where and at what point we're going to start to roll over. So one of the ways to manage that is when we start to get these signals and we're moving back in, we're still in momentum, then we start to see in the directional alerts, we start to see some of these shifts, mildly bearish in a bull market. Okay, so when we talked about that each morning, we talk about what's happening in the sectors. We're seeing sectors that are confirming that. Three to the buy side, a bunch in hold, one in sell, short-term trends are down. That's also confirming that we've got some internal bearishness happening on individual sectors as well. Okay, so that's where we're at currently in this current trend, and really seeing that on buy-sell ratio in addition to that. One of the other things to be paying attention to are what is the big term market economic perspective, because that is that matters. The bond market matters in terms of what are stocks doing, because we talked about this quite a bit last time, and that's why I won't get into this a whole lot, but interest rates ultimately create liquidity. Liquidity creates opportunities to chase goods or services. That money, that liquidity chasing those goods and services creates inflation. Okay, so when we have too much inflation, that can also create a whole different set of problems that the Federal Reserve is in charge of trying to keep that in check. So they manage the Fed funds rate. They're not managing the bond market. The bond market is entirely separate, but they do manage the Fed funds rate, which is the rate that banks are borrowing from the Federal Reserve. So it trickles down into the banking system and ultimately into companies and consumers. We can't refinance our homes, as at 6% versus 3% 2 years ago, and borrow that money is now it's costing us twice as much to borrow money as it used to buy a car, to buy a house, to do anything. And before, now and the idea is to pull money out of that system so that it's not quite as easy to get that money and then go buy stuff with it. Okay, and that ultimately slows things down, which ultimately slows down business and profitability. So the game is, do we break the economy trying to manage inflation, or do we have something in the middle? And that's that soft landing scenario that is often referred to and talked about. do we get enough slowing without breaking everything? And so far, at least the stock market has yet to determine if that has been if that's happened yet. We are seeing this in the bond market still. We're seeing that bond market continuing to slide, which means interest rates are going higher, which means that the bond market does not have much faith in the Fed's ability to cut more interest rates based on whatever, based on inflation, based on the possibility of recession. And we've talked about this. Some of those economic numbers are in play. Let's rewind here just a little bit and go back to directional alerts, market trends. We're sitting at the upper end of the range. Buy-sell ratio starting to weaken here a little bit. S&P 500. You can use other indices, but S&P 500 is an easy one just to glance at and say, where are we at? We've retraced, but we've got a couple bottoming tail bars right here. We're getting some buying right at that support area. You can see it just tagged that level. So there were some buyers loaded up, locked and loaded to be buying in at that support area. A little bit of a move here today as well. This is still a really bullish looking pattern, but when it starts to weaken and retrace, this is right where we want to see buying start to happen. Okay, at support areas, at key Fibonacci levels. This one here, this 565 would be a big one, but this one's holding up so far. We'll see if that adds in, if we get some momentum coming back into the market at these levels. There may not be as much breadth participation. Remember that the upper end of this range, you're going to get selling into these premium levels. Okay, prices are high. Institutions know that they're selling into some of that strength, and we've had a big run. We're now 2 years into this bull market, and that could also start to come into play here where we're at currently. Let's jump over. We talked about sectors. We talked about the market indices, paying attention to the bond market, paying attention to the bond yield curve. And I've mentioned this before. One of the things is that we just can't go all in and say, market's heading higher, AI, blah, 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 this or that, or, internet, or, you pick the trend, the current hot trend at the time. That's never going to be enough to keep the market going up forever without some kind of a retracement. Okay, and we have those. And the bond yield curve helps us realize what are the economic scenario, what's the economic conditions of, and how can the stock market be a part of that? It's just not healthy right now. It's not as healthy as it should be. So we still have a bit of an inversion on the yield curve. That doesn't mean that stocks can't go higher. It's going to ultimately come into play whether these economic numbers create more drama or not for companies. Okay, if we start to see profitability slowing, layoffs, weakness, slowdown in sales, things like that. That's the market conditions that we're in. Now let's jump over and talk at a individual stock level, because there's always going to be stocks moving higher. The new buy list is always pulling in a stock that has gone from a hold signal, okay, or a non-trending or a range-bound scenario. Okay, each of these colors, when we go from green up to extreme or red down to extreme, these are trending moves. Okay, this is we're either in an uptrend, we're in a downtrend, or we're not in a trend. And if I were to, this 6-month time frame on this chart is not fantastic, but let's go out to a couple years and see here. Let's see if we can find another couple of ideas. So on this symbol, 2 years, TRU, and you can see that most of the time you're getting these pauses back to yellow, but as it's moving higher, the bulk of the trend are in green, and that's ideally what we want to focus on, are the bulks of these trends. Eventually, these trends are going to reverse. They're going to reverse, and these are the scenarios that we don't want to be in. We don't want to be in these moves as they're continuing to move lower. Now, there's going to be times where you don't know if this is going to happen or if this is going to happen. If we're in an uptrend and it hits this downtrend area, this red, and then it immediately moves back to yellow. Well, guess what? You have yellow for a reason, because it's the transitionary period. This transitionary period is saying we've now gone from downtrending to non-trending into uptrending. And so you get this area right here that allows you to kind of look to see, okay, we're transitioning from one trend to another. or whether that's green or red. We also get whipsaw. Whipsaw is when you transition into a trending zone, and it doesn't last. We go into trending and it immediately goes back, and then we get reversal. It goes into downtrend. It doesn't last. It goes back into reversal. That's referred to as whipsaw in momentum trading. Really, in any trading, whipsaw is just that. You think, you anticipate, or your trading edge says you're going one direction and it doesn't, and you get stopped out. That's just a part of trading, and it's okay, because typically it's not that big of a deal. At least it shouldn't be. Okay, and that's the thing with money management, position size. Any of the whipsaw moves should not be a big deal in terms of how am I managing these trades. I'm going to only own stocks that are going high. I'm not going to worry about stocks that are retracing, and I'm not going to hold anything that is red, okay? Or if I've been at an area where I'm stopped out, because this can happen. That can take a long time to recover. This didn't take too long to recover, but that's just a different methodology. It's not to say, hey, I'm going to own this company and I'm going to look at it in 10 years. That's fine. That's a different methodology. In this case, for the most part, we want to be focusing on stocks that are moving higher and that have high ranks. So each of the scans are designed to do that. The new buys primarily is designed for these kind of names. These are highly ranked stocks. The ranks are based on performance in the last 12 months. So the ranks are not based on earnings or anything else. It's based on performance, because the price activity has all information baked in. And if large institutions think that company's earnings or lack thereof is worthy of it moving higher, then the market as a whole, or the trend or the demand that's there, is also what we want to follow. Okay, so Shake Shack, for example, okay, this stock, as it's moving higher and trending higher, we don't have to know a whole lot about the individual company and the fundamentals, because the market is helping us do that. The market is doing a lot of the heavy lifting. All of these hedge funds and pension funds and insurance companies that have billions and trillions of dollars under management, they're looking at all of these numbers, and they're buying and they're moving the price activity, and we can kind of just piggyback on that and say, okay, well, this stock is moving higher. Institutions must agree that there's value in that, and the trend is moving higher. And obviously, we can see there's rationale for the price to be moving higher, and ultimately, the rationale is always on a stock price. It is the earnings of the company. A stock price is nothing more than the present value of the future earnings of the company. So but the stock price is an auction. Okay, so you have buyers and sellers trying to determine what the current value of that stock is in real time. So it's a real time price discovery mechanism, and that can change as information changes. But primarily, what we want to focus on is let's just follow the path of least resistance, and let's focus on a stock. The purpose of a stock, number one, is that the underlying company, is designed to grow. Okay, and companies are designed to grow infinitely, forever. That's how they're designed. Do they do that? No. In reality, they don't. But in purpose, that's what they're designed to do. So what we want to focus on are those kind of stocks that can continue to move higher as well, and then create some structure around that process. We use Fibonacci levels to help us determine those zones. This is a momentum zone in this upper level, okay, where typically it does this. It might bounce around a little bit, then it breaks out of those zones. As long as we're in this upper zone, we're in the right direction, and now we can fine tune that trade structure just a little bit more to say, now this is really all that we really care about at this point. Okay, I'm just using Shake Shack just as an idea right here, but most of these stocks, when we're going through these new buys, they all look like this. They're in that upper zone. Now, this is important because a lot of traders determine, it's like, well, I should have bought back here, but I'm looking at the chart today, right? So if you were to look back here, and I've gone through this example in these classes before, because when you're looking at a stock chart, it's always easy to say, it's too high. I don't want to buy it right here. Now, this may not be the most ideal example. We'll find one that is. But my point is that don't necessarily avoid a trade because it's already sitting here in the chart. That's exactly where we want it to be. Okay, so if I were to go out to this 1-year chart, let me just refresh this. I'm going to refresh this and go to the 1-year time frame on this chart, and then I'm going to scale it back to something like, let's look at this new buy right here. Okay, so if you were looking at this chart on this day, which is in August, and you're saying it's $198, but it looks way too high. Okay, and high is relative just because we can see where the price has been moving already. And so we're saying, I don't know if I want to buy it. I should have bought it here, or I should have bought it here, or I should have bought it here. Somebody did. Somebody bought it here. It's all irrelevant now. The fact of the matter is the trend is continuing to move higher, and now we're focused on this area of the chart. Above the 236, it's trending higher. Because here's what ends up happening on good companies. It goes higher, goes higher, goes higher, goes higher. Okay, now it's retracing. You get a little bit of retracement, then you get more upside. Okay, and so now this is where we're at, but the location we were just looking at started right here. Okay, so when you're looking at a chart, it could be the same thing on this either. It could also not be. It could be the top, and it could retrace, but we have risk parameters in place so that we're setting up stop losses and we are adjusting these stocks accordingly. Now, this is let's go through this buy process here real quickly, and then we'll finalize. But let's take a look at let's go through and look at a couple. Let's look at Diebold. Okay, Diebold in the security space, armored cars, that kind of world. In fact, one of the things that you can go to that is always interesting, I like to go to more. I'll go out to Google, and then you can go out to their website right here and say, what the heck do these guys do? Maybe find out a little bit more about what they're doing, what they, ATMs and that kind of world. That's just a real quick way to say, okay. And then you can obviously dig in a little bit deeper from the website, just a potential idea for you there. But let's take a look at a trade setup. If we were to add this in, we're going to our portfolio. We're looking at a number of shares. Excuse me, if we add 100 shares, that's 3.92. That's too high. We want this number to be around 2 to 2.5%. So let's pull it down to 50. 50 shares is at 2%. Now we want to manage our stop loss. Okay, if I have my stop loss and I'm setting that below the 236, a stop loss is just the location that you're going to say, I've now got a certain amount of risk capital on the line. This is fresh new risk capital, meaning this is money that we've now earned. There's no profits in it. It could have come from profits. It could come from our cash pool, which could have been from profits that we've sold. Nonetheless, it's a fresh new trade. There's no gains on it. So we always want to know, what is our risk in that trade? Are we going to risk it all? Are we going to risk a little? What is that number? In this case, we're typically doing that 2% allocation, 2 to 2.5%. You can obviously go higher. In real strong early momentum bull markets, you could maybe go to 2.5% to 3%. If your account is a little bit smaller, you might have to go up to 5% or 7% or even 10% allocation to get a little bit more bang for your buck. You may have to take a little bit more risk on position size to grow that account. Now we want to set up our stop. Let's just say that we're going to set our stop below this low of 40. Let's call it 43.50. 43.50 gives us really, really tight stop on this. 0.10, $114, that's 5% at risk. Typically we'll get around 10%. Okay, but there's no reason to widen your stop loss if the technical area of the stop is already sound. Meaning, if we were to break below this area, I wouldn't want to be in the trade anyway, because it's probably going to be reversing back here. Structurally, it's starting to break through a lot of support. So when that starts to happen, we don't want to wait around and see if it's going to bounce. Let's just exit it and move along. That is a lot better way to create a systematic process instead of just wondering, oh crap, I just bought this and now it's dropped, and should I keep hanging on to it and wait for it to recover? Set all that right now. Okay, tell yourself right here, this is what I'm going to do, and that is, if it hits 43.50, I'm out. I'm done. Okay, now let's jump over an easy way to do that. What's our symbol? DBD. So if we're opening up a trade here. This is the brokerage account is Webull, which I really like it. I think you will too. It's very simple. It's very easy. It's easy to look at the chart, pull in especially your order functions, and kind of get a visual of what's happening on the chart. So in this case, you can utilize this chart trader and say, okay, I want to buy it here. We set a limit price pre-market before the market is open and say, if the stock gets to a certain level, then I'll buy. What I should say is I don't want to pay anything more than a certain price. In this case, I'm saying I don't want to pay anything more than this limit price of 46.16. If I were to click place order and the market opens, I'm immediately going to get filled on it. It becomes a market order because I'm saying I'm willing to pay anything lower than this amount. Okay, if it gapped clear up here, I wouldn't get filled on this because it's higher than my limit price. And if that's the case, I wouldn't want to be filled because I need to reevaluate the trade at that point. Okay, so that's a limit order. You can also set up a limit with a trigger on this. So if I were to set this and I were to click on buy, now I can set my limit price and I can pull that stop loss down to that area that we were talking about. Now, this is the risk that I'm willing to take. Okay, and we also can use our target. Okay, in this case, I'm just going to delete that. But what we're saying is if I'm willing to buy this stock at this price, my risk that we talked about, my stop loss location was down below this low. So I'm willing to allow this amount of volatility in this stock. If it closes below this, then I'm out. I'm going to stop out of that trade because for whatever reason, it's not going higher. I have no idea why. The market determines all of that. We can only, put in our best analysis. The stock is moving higher. We now have a confirmation of a new uptrend based on our methodology. And this is what we would expect to have happen from here. That's a really quick way to set that up. When you click on this buy order, it's now going to set up your stop as well. Most brokers will have this functionality to be able to do that. Now it's a daily chart. You're not watching it every second of the day. You've got your stop loss already set up so that it's on the books. It's set up so that if the stock did trade lower, you're going to get stopped out of that trade. If it keeps moving higher, then all you do is just keep raising that stop loss higher, trailing the stop loss. As we get to certain target levels, then you can set and say, when I get to a 20% level of gain, I'm going to sell 25% of my holdings. When we get to 50%, we're going to sell another 25%, and then we're going to trail the rest. Okay, so that's initially the process of entering, utilizing a simple stop loss technique, allowing what is that risk range that is acceptable for me. And in this case, that risk range equates to $114 if I'm doing 50 shares for this example. Okay, so my stop down there at 43.50, and that's a full process of market analysis. Where am I going to set up my trade? Which stock am I going to trade? What is my risk parameter? From there, there's nothing else we can do. We can't root for the stock to go higher. I suppose we can, but we have no control. We lose 100% control after the fact that we buy it, when we buy it, how much we buy it, and when we decide we're going to exit out of those trades. And that's really all of the functionality that you need in terms of looking for the edge of looking for good quality companies that are moving higher in bull markets, an opportunity for them to continue to move higher. We've managed our risk by setting up a stop loss, and then we're doing that often enough to build up a portfolio of stocks to where we have a handful of stocks moving at the same time. Some are going to be winners, some are going to be losers, some are going to be continuing to move higher. Some are going to stop us out, some we're going to have trailing stops on. We're managing that portfolio as we continue to move along each day. I'm going to end on that note. I appreciate everybody's time and effort, and we will see you next time. Thanks a lot. Bye now.